Why does one market move fade while another gathers speed? News may start the move. Options hedging can sometimes influence what happens next. To see how, we need one market participant and two ideas, delta and gamma. An options market maker continuously quotes prices at which others can buy or sell. Taking the other side provides liquidity, but every trade changes its inventory. Because its business is generally to manage that book, rather than carry an uncontrolled market view, it often hedges directional risk with futures, underlying securities, or other options. That immediate directional exposure is delta. The mathematical foundation is the Black-Scholes-Merton framework. Using the underlying price, strike, time, volatility, interest rates, and dividends, it estimates an option's value. For this story, two of its risk sensitivities matter most. Delta measures the immediate sensitivity of an option's price to a small change in the underlying price. Gamma measures how quickly delta changes. They are sensitivities, not separate predictions. Suppose a call costs 200 points and has a delta of plus 0.5. For a small 1-point index rise, its price should gain roughly half a point, assuming the other inputs do not change. Delta also provides the immediate hedge ratio, but delta moves. Gamma measures how quickly. Imagine a market maker owns that call and offsets its plus 0.5 delta by selling enough futures to offset that half-unit exposure. If the index rises and the call's delta becomes plus 0.6, it sells another 0.1. If the index falls and delta becomes plus 0.4, it buys back 0.1. After a rise, the long gamma hedge sells. After a fall, it buys. The response leans against the move. Now reverse the option. A short call has minus 0.5 delta, so the market maker buys enough futures to offset that exposure. If a rise changes its delta to minus 0.6, it buys another 0.1. If a fall changes it to minus 0.4, it sells. The short gamma hedge travels with the move. Gamma does not choose whether the market first rises or falls. It describes how hedging may respond afterward. Picture price as a ball. Long gamma hedging behaves like a ball inside a bowl. Small moves can face a force back toward the center. Short gamma hedging is closer to a ball on an inverted bowl. It does not choose the initial direction, but after the ball moves away from the balancing point, the response may carry it farther. Long calls and long puts have positive gamma. Short calls and short puts have negative gamma. Futures and the underlying have essentially no gamma because their directional exposure is linear. A real book combines them. Suppose long calls contribute plus 100 gamma units, long puts plus 80, short calls minus 120, and short puts minus 30. Net gamma is plus 30. The book is mixed, but long option gamma dominates after weighting each position by size, strike, expiry, and sensitivity. That is actual net gamma, if the complete book is visible. Public data is not so generous. Open interest records how many contracts remain open at every strike and expiry. Each contract has both a long and a short holder, so open interest does not reveal which side belongs to a market maker or what has been offset elsewhere. A public gamma exposure model therefore calculates gamma strike by strike, scales it by open interest and contract size, assigns an assumed sign for the dealer's position, and sums the result. Open interest is observed, the dealer position is assumed. Our illustration uses the common call positive, put negative convention. In position terms, it behaves as if market makers are long calls and short puts. Why make that assumption? Long-term equity owners often buy index puts as portfolio insurance and sell calls against their holdings to earn premium or help finance that protection. If a market maker takes the other side, it sells the put, negative gamma, and buys the call, Positive gamma. That recurring flow explains the convention but does not validate every contract. Customers also sell puts, buy calls, trade spreads, and take short-dated directional positions. This matters particularly in India's active index options market, where open interest cannot separate institutional hedging from individual, proprietary, or other activity. Some models improve the estimate by using trade and quote data to classify buyer and seller-initiated transactions and track inferred inventory. Institutional desks may have much better data for estimating how positions build through the day, but without complete dealer books and their offsets, the result remains an estimate, not true gamma exposure. We therefore call an estimate robust only when its sign and important levels survive reasonable changes in inputs, strike ranges, and positioning assumptions. If they change easily, confidence should be low. The gamma flip is the modeled area where total gamma exposure changes sign from a possibly damping hedge response to a possibly amplifying one, or the reverse. It is not fixed. Spot, volatility, and time can move the estimate itself. Expiry makes this mechanism more sensitive. Gamma is usually greatest near the current index level and close to expiration. A small move can then change delta quickly, requiring a larger and more urgent hedge adjustment. That can contribute to final hour movement, although news, heavyweight stocks, institutional orders, and liquidity can dominate. Now consider two recent expiry sessions. On the 21st of July, a retrospective Nifty reconstruction showed the public open interest estimate moving from slightly negative at the open to positive after 10 a.m. By noon, the strongest nearby concentrations were 24,150 and 24,200. From then, almost every minute close stayed inside that 50-point band, a path consistent with damping. On the 23rd of July, Sensex approached expiry with a mildly positive estimate close to the point where the model changed sign. The largest nearby concentration of put options was 76,700. Sensex briefly regained that modeled zone, then lost it and closed below. The level marked the retest. It did not become a floor. Actual behavior must confirm the model. In a positive gamma environment, repeated rejection beyond a zone, only a small number of stocks joining the move and contained volatility would fit the upright bowl. In a negative gamma environment, a momentary move beyond support or resistance is not enough. If price stays beyond the zone, more stocks join and volatility expands. Short gamma hedging may reinforce the move in either direction. Ask 4 questions. What dealer position does the model assume? Is the estimate stable or close to changing sign? Does the market's actual behavior confirm damping or acceleration? And how fresh is the map? Gamma may shape the path. It does not control the destination. Gamma exposure becomes useful when its assumptions, location, and observed market behavior agree. In the next episode, we will examine call and put concentrations and why a crowded strike can matter without becoming guaranteed support or resistance. Behind the movement is a method, sometimes a little madness, and always a model that must earn our trust.